Happy Tuesday out there, Team 42. It's your skipper here, Darius Dell, to present our macro minute for Tuesday, February 25th, 2025. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro question is, are markets throwing in the towel on President Trump and Elon Musk? I think it's a real serious question we need to ask. Our answers are, for now, yes. Will it last? Unlikely, especially considering how much both individuals are obsessed with being popular, given the sheer amount of time and energy they dedicate to social media. However, assuming that markets will be bailed out by President Trump's perceived sensitivity to asset price fluctuations sounds more like hope than an investment strategy. When we authored our Triple S's theme back in November, we did so primarily with the expectation that asset markets might struggle because of the sequence of fiscal, regulatory, and trade policy implementation. Thus far, we have been correct on that view, with the tariff, border, and regulatory policies implemented thus far proving to be a net negative for growth and/or a net positive for inflation. Overall, tariffs, trade, and investment barriers, reducing the flow of immigration, deportations, and DOGE budget cuts will make growth slow faster and inflation accelerate faster than what our model is currently projecting. Both outcomes represent surprises relative to current Wall Street economist consensus expectations and are meaningful risks to the current risk-on market regime condition as a result. All told, it is becoming clear to market participants that most of the outcomes President Trump's desires and controls via executive branch authority are net negative for the economy in growth and inflation terms. While tax cuts, deregulation, and expenditure reductions will eventually have a net positive impact on the economy and asset markets, risk assets may correct or crash by the time it takes to legislate those policy goals in late 2025. Transitioning to our 42 macro dashboard here. Loving this question. As always, we'll wrap up with the questions from our client community. I love this question. It's so good. Just says titled, is it over? Darius, is the world ending? Please advise. And there's a smiley face there because obviously the client is intending to communicate a joke here. My quick answer is probably not, but maybe, and this is something we've been talking about for months now, which is the width of the distribution of probable economic and policy outcomes is widening, and as wide as I've ever seen in my 16 years on global Wall Street. Let me say that again for those who maybe not be statistically inclined. The width of the distribution of probable economic and financial market and policy outcomes is widening, and as wide as I've ever seen in my 16-year career on global Wall Street. And unfortunately, the widening part of that equation is heading in the left tail risk section, or that way for you guys staring at me. I'm going right in my way, but that's even over there. So the fact that it's widening in the left tail risk section doesn't mean markets have to go down, correct severely, or crash. What it ultimately means is that there is elevated risk of those outcomes. And especially in the context of something we've been flagging in our positioning model for months, and obviously talking about in over the media and various podcasts, which is when you isolate the indicators in our positioning model that correspond to the medium to long-term time horizon, they continue to signal a reasonable probability of a crash in risk assets over the medium to long term. That's been the case. That precondition has been there for a while now, but obviously positioning, valuation, those types of metrics aren't catalysts for the markets to go up or down, but what they are they act as accelerants for the market to go up or down when there is a catalyst that causes them to go up or down. And so obviously, when going back to our executive summary here, when you think about the things that President Trump has sort of, kind of done from an executive order and or executive memo perspective or an international negotiation perspective, all this stuff is actually a net negative for growth and a net positive for inflation. That's stagflationary. And this is something we've been flagging with respect to our Triple S's theme since we authored that back in early November. So all told, does this mean the markets are at the beginning of a severe correction or crash? Maybe, maybe not. I mean, President Trump could come out and say, okay, maybe, we're going to take our time with, divesting from China as it relates to the memo that he authorized yesterday. Or we could further delay the Mexican and the Mexico and Canada tariffs. We could extend the study, the April 1st deadline for the study for global trade policy practices and currency manipulation. There's a lot of levers he can pull, right? He creates these deadlines for the market and then the people on the other side of negotiations to have to respond to. But then at the end of the day, they're not real deadlines. They're just things that he could punt into the future. So it's our general expectation based on the likely trend acceleration in U.S. liquidity that we're probably going to see over the next 1 to 2 quarters, as well as the ongoing, modest uptrend in global liquidity that we are experiencing and likely to continue to experience at least over the next 1 to 2 quarters, that asset markets, and oh, by the way, the Fed's probably going to end the treasury portion of balance sheet runoffs in the next 1 to 2 quarters as well. If all three of those things happen, and President Trump, comes out and does this good cop, act, then we could probably see asset markets, bottom and start to, grind higher from there. If all those things happen and President Trump sticks with the bad cop act, then asset markets are probably going to meander lower. And if what was the third outcome? No, those are the two outcomes really, because in our opinion, the liquidity stuff is pretty relatively straightforward to forecast, at least if you are good at forecasting this stuff like we are. So when we think about where we are in asset market terms, I just want everyone to take a step back and do what the question is. Sort of the underlying intent of the question is to talk everybody off the ledge. I mean, if you look at where the S&P is priced right now, we're the same price we were in mid-January, we're the same price we were in mid-December, and we're in the same price we were in mid-November. So nothing has really happened. It's just that we've seen, which is something we've forecasted, by the way, a significant degree of higher than normal realized volatility on a day-to-day and week-to-week basis because of the chaotic and frantic nature of President Trump's, policy, orders, executive orders, international negotiations, et cetera. There's just been a lot for investors to digest. And ultimately, all that uncertainty is causing consternation in the markets. And by the way, we talked about this on Schwab Network yesterday, it is already causing severe consternation in the economy. You saw a contraction in business investment in Q4. We've seen a crash in consumer confidence on both UMich and consumer conference board meetings this morning, a crash in consumer confidence. We've seen a below 50 print in the S&P Global Services PMI. We've seen a below 0 print in the New York Fed Services Sector Activity Index. Both of those are presaging a below 50 print in the ISM Services Index. The economy is grinding to a halt right now because of all the historically elevated policy uncertainty. And so these do represent, risks to the risk-on condition of the market regime. We may be entering a prolonged correction or crash, which is something we were anticipating in 2025 to begin with. We were of the view that would be something that'd be more like a summertime outcome as opposed to a Q1 outcome. But if it's a Q1 outcome, then we have, trust that we have the risk management systems to make sure that, our clients, miss out on the worst part of that decline. I would say, our systems are generally really good at capturing 2/3 to 80% of any uptrend in markets. I would say probably 2/3 to 85, 90% of any uptrend in markets. Actually, 90%. Yeah, no. The upside capture ratio for KISS, for example, for stocks, gold, and Bitcoin is 90%. So if you were just naked long 60% stocks, 30% gold, and 10% Bitcoin, you would our upside capture ratio, when you layer on our risk management overlays, which actually chop off the left tail distribution, the upside capture ratio is 90% and the downside capture ratio is only in the 40% range. So if the markets crash, you should expect to experience about 40% of the crash following our systems. But if the markets rally like they have been for 2 years and we've been on the right side of that, then you should expect to experience 90% of the return. So that's obviously a very positively skewed asymmetry that works in favor of our clients compounding returns much faster than they would, or most investors can without institutional risk management systems like we've built. So super proud of our system, super proud of the thoughtfulness of our clients for asking a cheeky question this morning. That gave me an opportunity to explain exactly how you should be thinking about the changing world order and how it's impacting both the economy and asset markets here as an investor. So we'll wrap it up there. Darius Dell presenting our Macro Minute for Tuesday, February 25th, 2025. Everyone have a wonderful day out there. Best of luck, and let's have some fun this year. Cheers.